Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And I want to welcome you to mid-2008, and I've made a video to give you a bit of an update of what's happening on a national scale in the property market, but more specifically, what's happening exactly in Melbourne, because as you know, I'm a specialist real estate agent that deals exclusively with the Melbourne property market. So I'm going to give you a really good understanding of what's happening in different segments of the Melbourne property market, which is made up of 390 individual suburbs. More importantly, I'm going to show you where the opportunities are and also which areas and what type of properties to stay away from right now, and especially for the next 12 months. And also areas that you should be targeting. So welcome. And also, I know I haven't done a video for a while, but with YouTube, one of the things I've chosen to do is I'm only going to do videos when I feel there's something very important for me to share with you guys, because I don't want to do videos just for the sake of doing multiple videos every week on different topics. I want to really give you stuff that you need to be aware of as an investor right now to make money in the current market. So for those of you who send me emails saying, hey, when are you doing your next YouTube video? Here it is, and I want to just apologize for the length of time it has taken me, a couple of months between now and the last video. Bit of a personal disclaimer before we get going. All this stuff is obviously for educational purposes only. There's no guarantees here that if you're going to listen to me or anyone's advice, you're going to become wealthy or have any type of result. Just like getting a gym membership, there is no guarantee that if you buy a gym membership, you're going to turn into Arnold Schwarzenegger. You've got to go and do the heavy lifting and make a commitment to go to the gym every week, every day. Why should you listen to me? For those of you who don't know who I am, I've got a number of letters after my name. In fact, I've got more letters after my name than in my name. But just to give you a bit of a summary, I'm a real estate agent, a mortgage broker, and I've also come from a background of financial planning. The most important thing is that I'm a real estate agent who happens to be a successful property investor. So I'm actually in the market every day, like you guys, looking at deals, talking to developers, talking to valuers, talking to other agents. So I've really got the finger on the pulse, and I really know what's happening right now in the Melbourne property market. Also, for those of you who are interested in learning more about finance, definitely recommend you pick up a copy of my book, which is just about to go bestseller, which is called Australian Property Finance Made Simple. You can get a copy by going to bookonfinance.com.au or go to any good bookshop around Australia or Amazon and pick up a copy there as well. Now, let's get into it. Melbourne and Sydney has really outperformed everyone's expectations in the last 5 or 10 years, despite all the doom and gloom and all the failed predictions that there's going to be a massive correction and that it's unsustainable. Melbourne and Sydney have really performed far beyond anyone's expectations. In fact, for January 2018, the combined value of houses in Melbourne in the last 10 years have gone up by 72.4%. Remember, that's a combination of all 390 suburbs. For Sydney, it's gone up by 79.3%, which is far beyond anyone's expectations. Now, I know areas in Melbourne that have done 150% just in the last 5 years alone, when I'll show you which those suburbs as well later on. So having said that, this has been a phenomenal run for the property market. And as any market, there has to be a breather. You can't just keep going at 9-10% per year indefinitely. The market has to stop and take a breather, which is exactly what's happening in Melbourne right now. Now, the last property cycle finished back in the day of 2004, where interest rates went up, and that's what's finished off the last property cycle. This property cycle has finished as a combination of a number of things. The most important being APRA putting a lot of pressure on banks to change the way the loans are looked at. So the algorithm, or the credit scoring algorithm, has changed, which made it a lot harder for people to get the same volume of lending they could 12, 24 months ago. Also, because of the royal inquiry into the banking system, one of the key fundamental things that has changed with loan applications is that now for people's personal living expenses, you can't just make up a figure out of thin air. And you'll know, if you were a mortgage broker 5 years ago, you would say to a client things like, okay, Mr. Jones, for you to get this next loan, your living expenses have to be below $1,200 per month or $1,500 per month. Is that the case? And if the client says yes, that loan goes through. Now, the banks have set a minimum living expense criteria for people living in Australia that you can't go below. Now, if you go below that, you've got to actually substantiate with a budget and 3 months with a bank statement showing you are actually living on $1,200 or $1,500 per month. So because of that, because of the combination of tightening credit policies and also more disclosure of your expenses, people are borrowing less money, and people's ability to borrow money has been restricted. And that has reduced the volume of investors in the market and the volume of lending in the market to a large extent, combined with a reduction in Chinese and foreign investment directly into Australia as a combination of government policy both in Australia and China that has further reduced the volume of properties that have been sold. And because of all these things combined happening at the same time, we're seeing a slowdown in both Melbourne and Sydney property market, which to me is a fantastic opportunity to make a lot of money. But I'm going to show you what has happened, what's happening right now, and what will happen in the future. Going back to the fundamentals, and I want to keep things really simple, you know, I look at the big picture, and the big picture is that in Australia, the real estate market is worth $7.5 trillion. We only have $1.73 trillion in outstanding mortgages against that market. So you've got to remember, as a nation, we hold 53% or 52.2% of our wealth in residential property. This market is too big to fail. Okay? There's too many parties involved, and the banks and the government will not allow it to fail or have a massive correction. Is there going to be a slowdown? Absolutely. Is the market cyclical by nature? Absolutely, beyond doubt. I mean, it's been happening like that for the last 50 years, ever since we've been collecting data. But the thing I want to impress upon you is the key fundamental that this market is the biggest thing that we have in Australia that you can invest in, and the volume of mortgages is very small. Because it's so small, people will sacrifice holidays, new cars, delay buying things, consumable products, but they will not risk their house. And this is the thing, house ownership is so entrenched in our culture in Australia that we're going to do everything we can to hold on to our properties, even if there is a downturn, because fundamentally people don't buy properties to make money. Majority of Australians buy property because it's a place they want to call home. It's where the community is, it's where the value system is. It has nothing to do with making money. Only a small percentage of homes that are owned by private landlords are open to speculation. And that's why the market's been so resilient, and this is how I keep going back to this key fundamental. The market will not crash in Australia. I've been saying that for the last 15 years. Will there be corrections? Absolutely there'll be corrections. Will there be a slowdown in the market? Guaranteed. What's happened in the past, it's going to happen in the future. In terms of Melbourne property market, you can see there's no such thing as a Melbourne property market anymore. There are very distinctive markets now doing individual things, and these markets are very fragmented, and there's really no correlation between them anymore. They're doing very independent things with no spillover effects virtually between each other. But one thing that I want to just share with you is, where are the opportunities right now? House and land stock has shrunken a lot because of tightening credit policies, and developers can't get funding to buy large parcels of land on the outskirts of Melbourne. Beyond the fact that there's 4 large property developers, Australand, Simmons, Burbank, and Metricon, who have very large land holdings in the so-called 4 growth corridors in Melbourne. Having said that, I would stay away from house and land packages completely. I don't think there's going to be any growth there for the next 3 to 5 years. I think you expect growth there for 3 to 5% at best. Inflation's 3.5%. What's the point of even investing in those areas? Apartments as well. Apartments, and I've been telling people for the last 3 years, I think Melbourne's oversaturated with apartments, even in the best suburbs. And the problem is, even in best suburbs like Hawthorn, Glen Iris, Bentley, Brighton East, even if you do get into a boutique development of say 15 apartments, which is completely a product that's developed for the owner-occupied market, because of values being so negative on apartment stock, even if your apartment does go up in value, you're going to get the most conservative valuation, which means your ability to draw equity out of apartments in the next 3 to 5 years is very restrictive. And that's why I'm shying away from apartments altogether, and I'm telling my clients, do not touch apartments unless you want to live in one. So what's the vehicle to build wealth in Melbourne? It's townhouses. Townhouses with a good land component, where you're buying in established areas, taking advantage of the established infrastructure, and having basically a house with no backyard. you know. And people have kind of they've given up on the backyard. We don't need a backyard anymore. People are happy to buy a 3-bedroom townhouse with large living areas, functional kitchen, double lock-up garage at the expense of having a massive backyard. And that's the vehicle that I choose to invest in myself, and that's what my clients are doing. So townhouses, guys, are it for the next 3 to 5 years in Melbourne in the best possible areas that you can afford to get into. In terms of our capital growth and what's happening in Melbourne, we are definitely going backwards very slightly. Now, when we say backwards, and I know the media loves to jump onto this bandwagon that the whole market's crashing. I mean, for the last quarter, Melbourne is going back by, 1.4%. So it's the analogy of driving a 911 turbo Porsche doing 300 k's an hour and then going from 300 k's an hour down to 270. Or I would say 297, depending on which way you look at it. Yes, it's still going very fast. So our market's still very strong. The fundamentals are there. Why? Because we've got 120,000 people moving to Melbourne every year. The only thing that could really affect our market, which is not being addressed, by the way, by both Labor and Liberal Party, is migration into and immigration into Melbourne. Both migrants coming in from other states and immigration from overseas. And that's one of the key issues that I think no one will tackle. I think personally we should reduce that number from 120,000 to about 50,000 per year. I'm a migrant myself. I was born in Poland. I came here when I was 9, so I'm all for migration, guys. But I think we should be super selective who we let into the country. And I think we should restrict the volume that's coming in, because Melbourne is becoming overpopulated and congested. And I can tell you now, just the amount of cars that I'm seeing on the road and the level of infrastructure is not there right now to support this constant influx of people moving to Melbourne. So I think that's one of the things that, if it does get addressed, you're going to see a slowdown in the property market. At the moment, no one's addressing it, no one's touching it, because it could be a career ender, okay? The moment you open up that Pandora's box, it could be the end of your career. It's one of these things where I think you should be reduced, but having said that, as an investor, I actually want population to keep on coming in because my properties end up being worth more. Melbourne has slowed down. The median price is 716,000. Sydney's 870,000. That's still a massive return on your money. You cannot make 10% every single year indefinitely with any investment. It's just not possible. So to me, it's slowed down definitely. And it's very cyclical. You can see there from 98, we have a cyclical nature to the market. And that's why I keep telling investors, don't focus so much on timing of the market. It's about time in the market. You buy a property with a 10, 15-year point of view of holding that property, and then you'll make some real money. Short term, there'll be volatility. Some years you'll have 6-7% growth. Some years you'll get 2-3% growth. I mean, that's the reality of the market. In terms of change in dwelling values, we have definitely seen a reduction. I mean, Sydney now has, Sydney is the biggest market in Australia. It's always the most important market. It always goes first. And it finishes first as well. And also when it goes into the decline part of the property cycle, it also starts that part of the cycle as well. And you can see that Sydney already has gone negative by 4.5%, where Melbourne, average over 12 months, has just gone up by 1%. But we can see on a quarterly basis, we are going backwards by 1.4%. So we are definitely slowing down. There's no question about it. In terms of this is more to do with the overall market in Australia. Now I'm going to focus exclusively on Melbourne because that's what I do as a specialist, and that's why I source all my properties. But I just want to keep coming back to this theme that the market is very cyclical. And it always makes me wonder why people get so surprised when we do enter the bottom of the property cycle, when things do slip and start going backwards a little bit. People are almost surprised and shocked. If you've got 10 properties, if you're a seasoned investor, it's not a surprise. It was going to happen eventually, and this is the time where you can make a lot of money because developers at this part of the cycle get very desperate for sales, and this is where you're going to be seeing things like vendor finance become available, where the developer will give you a 20% deposit in the property, or they'll finance that deposit, for example, themselves, or they'll finance the whole purchase of the property, which is what we're seeing in Brisbane, where the market is completely oversaturated with apartments. We're going to see vendors offering stamp duty discounts. I've got 2 properties right now in Coburg, townhouses for $645,000, with the developers paying the entire $35,000 stamp duty just to sell the last 2 townhouses in his development. Now, at the peak of the market, you can't get those deals, you know. So, you know, when the market's starting to turn and we have negative consumer sentiment evolving, that's when you have the opportunity to go in and get some real bargains. Think about the stock tax sale. You know, every year people line up at Myers for 2 days. People sleep out to get that fridge for $50. You know, get the dishwasher for $30. It's the same thing with property, guys. You got to take that same methodology and apply it to property, because that's where the bargains are, and the fundamentals do not shift during the downturn in the market. So where are we in the property cycle? Well, if you want to verify all this information yourself, I recommend you check out Herring Todd White Valuers, who release a monthly report on the property market. It is unbiased. In my opinion, the best reading you can do every month. And this is from June 2018, because July hasn't been finished yet. And you can see that Melbourne is approaching the peak of the market. And really, in the next few months, I'm expecting Melbourne to be at the peak of the market and definitely starting to do a decline. There is a bit of a delay with Herring Todd White, because a lot of the data that we have as agents, the best data is about 6 to 3 months old. The worst data that we have is 1 week old, okay? And the reason for that is because agents like myself, when we sell real estate, we take a long time to get back to RP data and various bodies and actually record our sales. I mean, I've held on to projects that I've sold in March that no one even knows that I've sold. The only people that I know that have sold those projects are myself as a selling agent, the buyer and the developer. No one knows, they haven't settled yet, so even the State Revenue Office doesn't know that they've been sold. So the challenge with a lot of these stats is we're always looking back at the market, and the best statistical data is really 12 to 6 months old. The worst data is probably a week or 2 old. You know, it's very inaccurate data. But you can see we're definitely at the peak of the market. I think we're about 12 o'clock on the property clock, probably going over to just over the 12 o'clock part of the cycle. So this is where you're going to see negative consumer sentiment. You're going to see the Harry Dent of the world trying to flog their book about how the market's going to crash, and unless you buy his book, of course, then you're going to be saved. And a lot of Americans coming over from the States saying, aha, I told you, Aussies, your market's going to crash, and here's the beginning of the crash. Now, when the market does turn around again, which it will, because we have massive population growth, they're going to disappear back into the cubicles, never to be heard from again, until the market reaches the peak again, and they'll resurface again with another book and another story, how the market's going to crash and how we don't listen in Australia, and we should be listening to them because Americans know everything. So, is every suburb in Melbourne currently in a decline trend? Well, of course they're not. In fact, what we're seeing is we're seeing a lot of good opportunities, and this is on a national scale as well. And this is an interesting part of the danger of grouping all the suburbs together and making general statements about the market. Now, if you look at pricing in the market, you can kind of divide the prices in the market by 10 different segments. Number 1 being the cheapest segment, and the 10th percentile being the most expensive high-end properties. And this is obviously based on different states, and different states have different levels of properties. For example, in Sydney, the 10th percentile will be 2.5 million plus. In Melbourne, it's a 1.5 million plus. In Hobart, it could be $650,000 plus. So it's relevant for every state. Now, when we say that the national value has gone back a little bit, we're saying that overall, all the properties in Australia as a combined volume have gone backwards a little bit. But what you're going to find is, especially in Melbourne, is the middle segment is actually doing quite well. So properties in Melbourne around the 550 to 850 mark are actually doing about 8 to 9% growth. What has come off in Melbourne is the top end. The mansions, which are worth $2 to $3 to $4 million, have reduced in value by around 10-11%. But it's not so much they've all dropped in value, it's actually the volume on the market has shrunk from, let's say, 40 houses in Toorak that should be advertised every month. Toorak might have 12 or 15 houses that are advertised every month. And that's what's really occurred currently in the market. So the top end has dragged the median prices down for the entire national level of the market. And this is very true for Melbourne and Sydney as well. The dwellings have fallen by 0.7% over the April 3 months to April 2018. And over the past year, dwelling values are 3.7% higher, although they're now 1.1% lower than they were at the peak in November 2017. So we're definitely seeing a decline, and we can see, I think this will go down a lot further. Potentially will go down to the level of 2018, and then guess what? Well, the moment it hits this point here, it's going to come back again. Mainly because at this point here, it's actually cheaper to own the property and pay a mortgage than it is to rent. And this is the line of resistance right here. So the property market will bounce back from that line of resistance and go back up. Because eventually, your rental exceeds your repayments on the property, especially with apartments. So you're going to see apartments recover probably in Melbourne in the next 3 to 5 years. So in 5 years' time, I think apartments will start, giving you a return of 6-7%. And this is in the best apartments in the best suburbs, but for the next 3 to 5 years, I would stay away from apartments. But eventually, apartments will be cheaper to buy and make mortgage repayments in Melbourne than to rent them out. And the moment that happens, there'll be a recovery in the market. The most important thing to understand from a high-level perspective is that we are currently at the lowest level of lending in terms of interest rates that I've ever seen. In the history of lending. I mean, we've got a bank swap rate now of 1.5%. Standard variable rates of around 4 to 5%, depending on which lender you're looking at. I mean, we are right here. I mean, have a look at what we've been through in the past. I mean, we got up to interest rates of up to 19-20%, in the 80s. So money is cheap. However, having said that, because of APRA's pressure on the banking system, the serviceability rate that the banks use currently to work out your serviceability, which is called the benchmark rate, is 7.5% principal and interest. And that's why they've increased that benchmark rate to reduce the volume of lending that people have been able to get from the market. So once again, it is cyclical, guys. And what you want to do is you want to buy long-term with a long-term view. You do not want to guess the market. If you try to guess the market, you will fail 9 out of 10 times. I've never met any successful investors out there that have guessed the market and beaten the market. All you do is you buy, long-term view, you hold for 10 years, and then you look at your situation. Obviously, you review your portfolio every year, but I'm saying you're buying a property with a 10-year view. Especially with stamp duty and agents fees, you're probably losing 60 to 100 grand on the way into a property just with stamp duty and fees, depending on what you're buying. So you do end up with negative equity in the property. Auction clearance rates in Melbourne are very fragmented. If you look at, for example, the different parts of Melbourne, Melbourne is very fragmented now. We have the inner part of Melbourne having an auction clearance rate of 71.6%. And then we have, this is for the March quarter, for example. Then we have inner east 60%, inner south 71%. We've got a variance of between 73% and 60%. So that means 60% means 6 out of 10 houses that are auctioned are sold and 4 are passed in. Now, you can look at it two ways. You can look at it, 4 houses didn't sell. And mind you, vendors are always unrealistic about how much the house is worth, right? They always think the house is worth more than it's really worth in any part of the market. And buyers obviously want the bargain. To me, if I see things like inner east selling at 60% of properties getting sold, that means there's opportunity to make low offers on the 4 that were passed in. The best time to buy property is after the auction and the property has been passed in. Because remember, that agent hates the property, they hate the vendor. All they know is at the end of the month, they've got the Mercedes-Benz payment they've got to make of $1,800 because they've got to have the latest Mercedes-Benz or BMW or Audi, otherwise they're shit agents, right? And they've got pressure on them to make that payment, and that's where they start working for the buyer, which is you. So what you want to do as an opportunity is make lowball offers on those 4 properties that were passed in. So I look at everything from a positive perspective. I look for every opportunity and every danger, there's an opportunity. In every chaotic situation or in every opportunity where the market's at the bottom of its cycle, there are opportunities to make money. Looking at the median price value for Melbourne, it's unbelievable when you think about the fact that houses have hit $825,000 now. I mean, that is a huge amount of money for Melbourne. At one point, we've hit just under $1 million. for 1 month, which is incredible. And it went down to 825,000. In terms of what the market's doing right now, rental yields are still very good. For houses, they're at record low levels for 2.6%, because remember, there's an inverse relationship between capital growth and rental yields. Apartments are getting much higher rental yields, as 3.9%. I've seen apartments renting at even 4.25% in key areas, in key boutique developments. So much easier to hold on to stock, much better quality, much easier to borrow money. Townhouses are somewhere in between. They're renting between 2.9% up to 3.75% for the average townhouse. So you've just got to be aware of, that's a very important thing to understand when it comes to finance and which property to target as well. Bit of a thing about the downturn. So Australian home prices have fallen 0.3% over the past 3 months, leaving the increase over the past year as just 0.2%. So we're definitely flatlining as a nation. New research from CoreLogic reveals it's only the top of the Australian housing market where prices are currently falling. When you talk about the top housing market, you're largely talking about Sydney and Melbourne as the largest and most expensive cities. That's the finding of new research. CoreLogic that found that broad-based declines across the nation, it's actually only Australian most expensive properties that are taking a hit at present, and the top end is dragging the median price down, which is very interesting. And we're talking about properties that are located on the 8th, 9th and 10th percentile. And if you look at that, and I'm just going to show you the graph, this is for the national average, you can see that this is for the annual is the red, and the quarterly figure. You can see for the year, the top end has gone down by 4.3%, and then for the quarter, 1.7%. But you can see the middle range properties on the national average are still doing quite well. If you look at, for example, Melbourne, we have definitely had a decline in the top end. So even properties from the 6th percentile, the top end is definitely going down, 2.4% for the most expensive properties. But if you look at our properties around the 550 to 800 mark, they're doing 8%. And what's happening in Melbourne at the moment as well is suburbs like Frankston North, Glenroy, Sunshine West, all the suburbs that are the cheapest suburbs but very close proximity to the city, Headfield, they're doing 11-12% growth right now, because you can still get into those areas where you can get a detached house for $500,000, $600,000, $700,000, but townhouses for $400,000. So the lower and entry level of the market is doing very strong right now. The middle market is doing fine, but the top end has definitely come off. And as a result, it's dragging the entire market into a negative territory. So remember, as an investor, you've got to be very discerning. You've got to be able to dissect the market and break it down into things that you can apply as an investor. So where are the opportunities right now in Melbourne? Well, depending on how much money you got to spend. But if you're a budget investor, I'll be looking at areas like Frankston North. I'll be looking at areas like Keilor Downs. I'll be looking at areas like Sunshine, Glenroy, areas that are kind of ugly ducklings, even Coburg, where you have an area that's surrounded by good areas, but that area has been underperforming, going sideways for nearly the whole cycle of the last cycle. And now at the very end, the price difference is so dramatic between those suburbs and other surrounding suburbs, like Headfield, for example. And what's happened is people are going, well, this is so cheap. Why is it so cheap? It's only 11 k's from the city. Let's just buy it up before it goes before it starts going up. And that's where the opportunities are right now at the tail end of the property cycle. But as a buy and hold investor, if you've got good serviceability, stick to the middle range properties. You can't go wrong. You're always going to get good tenants, and you're going to get good rental yields and long-term good growth. So can you buy a property in Melbourne for under $500,000 in 2018? Absolutely you can. I mean, I did a video on this a few months ago on YouTube that you can check out. There are plenty of opportunities to get into Melbourne under $500,000. You won't get a house on an 800 square metre block, but you can get really good townhouses and potentially houses on smaller blocks in areas that were kind of third tier areas in Melbourne, some of the least liked suburbs in Melbourne. Townhouses are definitely the vehicle to focus on for the next 3 to 5 years if you want good, consistent capital growth. They'll be performing really well, especially townhouses in the eastern suburbs and the Bayside area of Melbourne and the inner south and the southeast. You just can't go wrong with them. People want to rent them. They're good, especially 3-bedroom townhouses with double lock-up garages. I mean, they just fly off the shelf, and when it comes to rental, people are literally fighting over each other to get into them. So that's what I've been focusing on with my clients, and that's my strategy for the next 2 years, is purely just townhouses in the best parts of Melbourne. Interesting thing is a lot of townhouses now are outperforming houses in the same suburbs. Like, for example, McLeod, the median price for townhouses has been they've gone up by 58%. The median price is 640, where the detached house is 912, and the average growth has been only 9.5%. So places like, we call them the Bridemaid Suburbs, where, for example, you grew up in Kew, you can't buy Kew because your parents bought in Kew, but you grew up with your parents, you're priced out of Kew. What do next? You go to Kew East and you get in for 910,000 instead of 1.7 million. Strathmore, Moorabbin's another example. Townhouses are 600,000, 700,000, where a detached house is 1.1, 1.2 million now for the worst properties in Moorabbin. Heidelberg Heights is another good example where you're going to get really good capital growth. Last 12 months, 35% growth. Heidelberg's always been really good. Upper middle class suburb, big houses, big blocks. Over the highway, you've got your Bridemaid suburb, which is Heidelberg Heights. A lot of kids that grew up in Heidelberg, when they stay in the area, close to their parents, close to the community, they can't afford Heidelberg, they go to Heidelberg Heights. Bulleen, Chirnside Park Sportswood, and Williamstown North as well. So these are examples of properties that are areas that are doing well right now. They've had record growth in a market that's supposedly going backwards. So just because the 390 suburbs combined are going backwards by 1.4%, it doesn't mean that every suburb in Melbourne has gone backwards. And these are examples of the last 12 months to March growth in some of the key areas in Melbourne. Guys, there's always opportunities to make money out there. It just comes down to your knowledge and your level of awareness and how resourceful you are. So what's the next step? If you've enjoyed the content of this YouTube video, there's a couple of things you need to do. And remember, your education could never stop if you want to make money. You need to constantly learn new strategies and learn from people that are doing it right now. So if you want to commit yourself to long-term education, I encourage you guys to attend my up-and-coming Real Estate Fast Track Weekend. You can go to that website right now or scroll down below this video. There's a link you can click onto and we'll take you to a registration page. These events are run 10 times a year. They do book out really fast, and it's 2 days of pure content and pure education. Day one is classroom environment. We focus predominantly on finance and how to structure and build a large property portfolio from scratch, how you can automate the whole thing, and then how you can replace your income. Day two, we put you on the bus and we take you around Melbourne and we take you to about 5 or 6 different areas and we educate you on those areas and projects in that area. So you become a really hands-on expert on key areas of Melbourne. These events are amazing. There's a lot of education, a lot of content, and I encourage you guys to grab some tickets before they do book out. Also, if you want to read more on finance and including a chapter on 12 ways you can turbocharge your borrowing capacity, grab a copy of my book on Amazon or bookonfinance.com.au. Also, because you've been so good and you stuck through this entire video, and because I haven't done a video for a few months, I want to give you a free gift. Access to my bonus home study, which is valued at $497 and absolutely free. There's nothing to buy. You can literally just opt in and you can start watching it in seconds. It's very easy to navigate through. It's literally 12 hours of videos, plus you upload a PDF manual of 297 pages. It's absolutely free and instant access. All you got to do is scroll down below or click this link, which is down below, and you can start watching and educating yourself on how to become an expert on real estate investing. Thank you very much, guys. It's been a pleasure. I hope to see you in person at my up-and-coming live event. And if not, this is Konrad Bobilak. I'll see you on the inside.